Welcome to the Restaurant Boiler Room, Season 7, Episode 1. I'm your host, Rick Ormsby, Managing Director at Unbridled Capital. Today in the Boiler Room, it is our annual State of the Union webinar for the franchise M&A industry in 2025. The Unbridled team will be joining me to discuss an array of topics, including supply and demand, valuations, multiples, cap rates, lending, franchisors, when to consider selling, how the macroeconomic situation is affecting deal flow, and many other relevant trends expected to develop in 2025. Now, this is a jam-packed episode, so make sure to listen all the way through. The Restaurant Boiler Room is a one-stop shop for multi-million-dollar merger and acquisition activity and financial complexities affecting the franchise industry. We talk money, deals, valuations, and risk, delivered to the front door of franchisees, private equity firms, family offices, large investors, and franchisors on a monthly basis. Feel free to find our content at Unbridled Capital's website at www.unbridledcapital.com. Now, let's enter the boiler room. I want to thank everyone for attending today. This is our State of the Union franchise webinar for 2025. If you are hearing this in a couple of weeks on the podcast, The Restaurant Boiler Room, I just want to say what's up and thank you for listening. I was checking the statistics and we've had something like 200% growth in the podcast over the last year and a half. I'm really proud of that. And we're going into season 7 of the podcast. I can't believe that. My wife would tell you I could talk for 100 seasons, just give Rick a mic. So maybe it's not a big surprise, but time flies, so if you're listening to this in the future here, thank you so much. And, we'll do like we always intend to do every year. We'll do probably 4 or 5 webinars. We've got a couple of good ones slated for the rest of the year, usually doing once a quarter, and usually have a lender come on board. Maybe we'll have an attorney come and talk about some of the deal terms that they're seeing in some M&A transactions. We'll have a kind of a year-end wrap-up one. And then we usually have somewhere between 8 and 10, maybe 12 podcasts that happen throughout the year too. And you can find all that stuff on our website at unbridledcapital.com. So as we kick it off here, you got Derek Ball, you got Peter Fisher, and you got Raymond Buehner, 4 of us, 3 guys that are deal guys in our office. And I'm excited to go through this commentary here. And so, fellas, are you ready to make it happen?
Let's do it.
Let's go. All right, here we go. So, and before we start, those of you who are on, just a couple of things. Number one, you raise your hand if you want to ask questions. And guys, why don't you just keep your eyes open for any questions that are asked, and we'll just answer them as they come in or as it's easy to answer them. That's number one. And then number 2, if you would like a copy, we'll send out automatically a copy of this to everyone who showed up on the webinar. So if you missed something, just check your email inbox in a couple of days and you'll see a copy of the webinar and a link to it. So there you go. And with that, I guess what the format here was we kind of put together 10 questions. And so we're going to just kind of opine on 10 questions that I hope will provide a lot of insight and valuable information for you. The first question is going to be a commentary on current supply and demand for buying and selling franchises. And I just open it up, guys, and let you guys comment on that. What do you think? What do you think for 2025?
I'll jump into it then. I don't know if it would surprise anybody out there. The deal flow we're seeing is extremely low, possibly record low, short of March of 2020 in terms of new deals. We currently have 7 engagements across 5 brands. That's probably half of what we would normally have. And those aren't necessarily new engagements. I think all but 1 or 2 of those are locked up with buyers that we've just been working on and looking to close in the next couple of months. Last year at this time, we were getting a lot of inbound phone calls. We're not getting those right now. And I guess we can kind of go into why. We predicted maybe the only prediction Unbridled has ever had that's come true.
No, come on. Come on.
Is I think on this webinar in July, we predicted if Trump wins, it would be a really slow year. And if the Democrats at the time, Biden, then Harris won, it would pick up with a lot of people looking to sell. So Trump did win and it's slow. So, maybe our prediction might actually be coming true. I think that'll end up flipping. I think there will be a couple of really busy years, but generally speaking, there's a lot of optimism and franchisees usually need that additional reason to sell beyond just finances. It's I'm scared of taxes increasing. I'm scared of the next administration. I don't have a succession plan. There's usually some ancillary factor that pushes them to sell. And right now, people are pretty optimistic. So it's just not a time that people are thinking, I need to sell my company or I want to sell my company. They're just kind of riding what they think is going to be a strong few years. Anybody else with commentary?
Well, I'd say that probably leads to it being more of a seller-friendly market. As you said, there's just not much supply out there at the moment. It's been like this for quite some time. You know, as you mentioned, the election, since the election last year, during that time period, it's been kind of a slow back end of last year. And that's just following up through the beginning of this year. I'm not saying the EBITDA multiples are about to skyrocket or anything, but assuming your business isn't struggling, should be a lot of interest for your business if you do try to and decide to sell.
Well, it's a little different. Last year, the supply was pretty low. I would say it's lower now, but the buyer sentiment was also pretty negative. Anybody that went to RFDC can probably agree that buyer sentiment and just the general tone of the conference was really positive. Everyone's really happy, cheery, excited about the future. So you've got a lot of buyers that want to buy, but there's no deal flow. Last year, you didn't have a lot of deal flow, but you didn't have that many buyers either. So it's a little bit different. The one thing that's staying the same is there's not a lot of sellers, but I think for a different reason. Last year, it was valuations were too low. Now people are excited about actually owning their company for the next few years. So,
Correct.
Yeah, good comments, I think. Do you have a comment, Raymond? Go ahead if you had something you want to say.
Yeah, I was going to say, just adding on to that, it's kind of an interesting dynamic. You know, when the future looks rosy and people are optimistic, a lot of sellers are going to take a wait and see approach. Because, you know, why sell now if, 6 months from now they think, they're going to be rolling over great comps and it might be a better time for them then.
Yeah, that's a good point. And I mean, those of you who know me, I've always marched to the beat of a different drum. I'm always the guy when they say go left, I go right, or go up and I go down or whatever. So I appreciate what you were saying, Peter, about the supply demand situation being, and we'll talk more about this, but it's a really good supply demand situation if you have a very strong business. And we have one example. We had a big Taco Bell business on the market about 4 weeks ago that had like crazy amount of interest. Just as much interest really as back in 2021 when everyone and their sister was trying to buy restaurants. So if you have a good business, the contrarian would say that there ain't nothing out there for sale. So you might have a decent time, but the thing is, you probably if you don't have a business that's strong right now, then that probably doesn't work in your favor. And why is it slow? I mean, EBITDA right now in Q1 for many of our friends and clients and franchisees, many of their EBITDA is up right now over last year, right? So it's naturally a time where, since most of these businesses sell on a multiple of a trailing 12 a month EBITDA or trailing 13 period EBITDA. To put just some more meat to the bone, like keeping a business while it's improving its EBITDA, in the immediate past is going to mean higher valuations for the future. So that's one thing. And some of our clients are saying that their Q2 and Q3 comps are going to be more difficult to roll over. Cost inflation has moderated a little bit, at least for now. I don't know what the future is going to be, right, with some of the things we're hearing on TV, but for now, cost inflation has moderated a little bit, which again is making its way through the P&L. And hopefully that's something that an operator or a franchisee would say, okay, I want to bake that or build that into kind of what my trailing 12-month P&L looks like. The hope for the new administration is palpable. I mean, there's no doubt about it. I said it at RFDC. I said, and I'll say it again, I believe in the future of our country. This is the best place in the world to live. And we're going to be kicking some butt over the next couple of years. And if you're not, if you're just kind of hanging your lip right now, then I think you're in the wrong boat, So the rising tide does lift all boats. And I think there's some optimism for the future, especially for our industry. We got to get through some of these challenges of the consumer sentiment being kind of low and spending being kind of low and too many restaurants in our business. So some of these things have to work themselves out, and that's going to take some time, and then we'll talk a little bit more about it. But, while there are a lot of buyers now, and more buyers certainly, and a better temperament among the buyers than there was this time last year by a landslide, we still don't have a whole lot of connection with the financial buying community as much as we did. And the question could be, and this is for another question down the line a little bit, will it ever come back to where the financial buyers are back in full force the way they used to be, the private equity guys and family office guys back in 2018, 19, 20, and 21? I guess we'll have to see. So that's any other comments? I guess we'll just move to the next one. And what do you think for M&A activity for 2025? And we kind of answered this a little bit, but what do you think will happen?
I'm not seeing any reason for it to, shift from what we're seeing currently. I mean, sometimes it's just slow a little bit to start the year, but I think, like you said just a minute ago, the wait and see approach. Unless something happens on a grand scale, I don't see franchisee sentiment and people just start picking up the phone to call us to sell. If that happens, it's probably not a good thing in general, I'll be honest. So I don't personally see it shifting all that much. That's my opinion.
Yeah, I think we kind of hit on everything, just a minute ago, but, with the strong comp starting out at the beginning of the year, hopefully it picks up some soon, but like Derek said, I don't see it changing much here soon. And then, but, strong back ends of last year might decide to speed up the process a little bit to try to get out in front of that. It had strong back ends of last year and try to beat that before it comes.
Yeah.
Yeah, I would say we definitely expect the second half of this year to be a little busier than we are right now.
Yeah, I think so. I think I think as we get into the third quarter, probably we'll start seeing some more activity. Most people at that point, most folks have had a pretty decent, I mean, not all brands, but certain brands, most brands had a decent Q4 of last year, good Q1 rollover. If they can deliver decent Q2 and Q3 results, I think you could start seeing the market start to kind of open up a little bit in the back half of the year. A couple of comments I would say, we've closed 3 transactions in the first, 28 days of the year. I guess today's January 28th, 2 Burger King deals and a Pizza Hut deal. In our business, from the time we sign up a client till the time the deal closes, I mean, in some cases it's longer than this, but the average is like 6 or 7 months, right? And so in the fall period of 2024, about 3 months prior to the election up until the end of the year, it was really, really bone dry for obvious reasons. People were sitting on their hands and uncertain about what was going to happen. And I think that's going to cause the closings that you see 6 months later, like in Q1 and Q2 and Q3, to be really light. So we have kind of a delayed effect of what we do. When we're not taking assignments in September of 2024, that means in April of 2025, deals aren't closing. So I think it's going to be here for a while. It'll feel longer to you all than maybe it really is, just because of that lag effect. But the one thing that I would just say is that we continue to have a pent-up demand. I mean, everybody, I don't care who it is, if you're like fixing swimming pools or you're driving a plumbing truck or whatever you're doing, like there's this like pent-up demand that's kind of in our economy. And I just kind of feel like with, over the last 3 or 4 years, a lot of our clients and friends, and even some of the big financial buyers, some of the big sellers, some of the big private equity groups have been kind of holding these investments and holding these investments and holding these investments and holding these investments. And it'll become time for them to sell them, and they've been delaying it. And so the professional owners are looking for the timing to be right. And many of their funds are past their lives. That's one thing. If the market is met with a bit of more optimism, I think that, and some of the financial buyers come back, there's going to be probably a really nice frenzy that develops for some of these businesses as they improve. And then some of these legacy owners who I've been friends with for all these many years are getting tired and probably realized in 2022 and 2023 that they might have done better to sell a couple of years earlier and didn't do it. No one's getting younger, and these businesses are not getting easier to operate, and the franchisors are certainly not getting easier either. And that's something we'll talk about a little bit more later. But so all this stuff is out there that may impact the M&A activity in 2025. I mean, what's the winter look like? That's something that'll make us curious to see. And then I think we'll see smaller brands continue to gain traction and grow. And we've certainly seen that amongst our clients and friends who have kind of gotten into a second or third brand and are really growing it. and are like adding new stores like crazy. So the DNA and the heart of a lot of our clients and a lot of people in the industry is around development and growth, right? And so many of us do get excited when we can see a palpable brand, and there's many of them, some in the coffee space, some in the chicken space, some, just emerging brands in all kinds of areas that are really growing. And so I think there's a lot of kind of quiet optimism in those emerging brands. They're still too small to get financed on a big scale by large banks in many cases. And some of the bigger buyers are not yet ready to make a dash into the brands because of their size. But I think there's a lot of quiet optimism there. I don't know if I've said anything jump in your mind from what I said there, guys?
No,
I think it's exactly right.
Yeah. Well,
here's a question, Rick, that we just got that you love. I know you like talking about. Why do you think there's been a shift from the financial buyers? And we've answered this on some prior webinars, but we can briefly touch on it again. Why do you think there's a shift from the financial groups, and who's taken their place?
Yeah, well, I mean, I certainly do have an answer for it, and a case study right on this recent Taco Bell deal that we had. We had like a mountain of offers, and none of them were from financial buyers who did not, were outside of the restaurant business. And that's shocking. I don't know if for those of you who are listening, you wouldn't find that. You're like, okay, who cares? But usually when you run a process on a big Taco Bell asset, which is really heavily marketed and lots of people want it, half of the people who make an offer on it are going to be from totally outside of the system. They're going to be representing a private equity fund or a family office that doesn't own restaurants in another brand or in the Taco Bell brand, but wasn't the case at all in this time. So I think that's kind of a data point for what I'm about to say. But these financial buyers, a couple of things. Number one, comps haven't been the best. Number two, we have a high cost of debt that really hadn't come down, even though interest rates have been, even though the Fed funds rates come down, rates haven't really changed a whole lot, right? And so, number three, the cost of development has been high, and so it's impacted the new development returns. And most financial buyers, if I had to kind of characterize it, probably think of 2/3 of their growth in an asset that they're going to buy and then sell 7 years later or 5 years later to be in the new development, not in the existing stores that they're just going to improve and get same store sales growth from. So if they can't get profitable new unit growth, they're out. And so interest rates impacts that. Kind of a bad economy may impact that. Kind of oversaturation of restaurants may impact that too. So those are kind of some of the factors I think that are causing them. The one thing also I would say about the private equity and family office group, and you asked a question, I'm answering it, and I'm talking a lot, so I'm sorry. But the one thing I would also say is these guys, they talk with each other a lot. And, I've found that to be really kind of an interesting revelation. If you go up to New York or increasingly South Florida, most of these guys know each other and they attend the same kinds of events and they hang out in the same circles. And so if someone has had a bad experience with an investment in a certain sector or area, it gets around pretty darn quick. And we had a couple of high profile kind of failures and a couple of quiet failures over the last few years. And so I'd characterize our, kind of the consolidation or aggregation effect in our industry to be probably in the 7th inning. And so, they're kind of starting to hear this and see some kind of high profile failures or poor investments, and they talk about it with one another. And I think that's kind of one of the reasons why they're backing off too. Would you guys want to add anything to that? I mean, anything? First of all, do you agree that we're in the 7th inning of this aggregation or consolidation? I don't know. What do you think?
I never fully understand all of your analogies. I mean, I get the concept, but I don't think about them like you do. So I'm just going to say yes to your 7th inning comment.
Okay. I don't have much behind it except for I just stare at the ceiling at 3 a.m. and these things come to my head. And, my wife looks at me and she's like, you're like, something's wrong with you. Like, so, yeah.
And I think a lot of it had to do with the organic growth part of your statement and the oversaturation of other restaurants already in the marketplace that just kind of scares them away when you can't grow it and capitalize on your investment.
Am I right about that, Peter? I mean, your family was a Taco Bell franchisee, right, in Mississippi, and isn't a lot of the excitement around for these long-time operators and private equity alike in the new growth and the new units that you're looking to build and secure and develop? as much as it is the existing operation?
Oh yeah, I mean 100%. I mean, we were smaller operators, so we focused a lot on our current operations, but we're always looking for ways to grow and build new stores as well.
Yeah, yeah. I think when people feel good that that's going to happen again, I think that'll be a key marker. Okay, so what do we think? Let's talk more technical stuff now. You ready for the technical stuff? EBITDA, multiples, and cap rates. All right, so let's start with cap rates, and then we'll go to EBITDA multiples. Cool.
Sure.
What do you? Anyone want to start off and make a mention or comment on cap rates, or I can if you want me to. But anyone have anything to say? Go ahead.
Raymond, go for it.
Yeah, no, happy to jump in here. So cap rates in general, I'd say in the REIT market, they've moved favorably recently. I think last year at this time, putting people 7.5% to 8%. Now I think, we're close to that 6.75 to 7.25%. Still low transaction volume though. We think, just talking with some of the real estate people in our circles, I think we've definitely hit the bottom this past year, just in terms of transactions. So I'd say we're definitely on the upswing in that sector.
Mm-hmm. It was pretty bad, right? The REIT market was locked up a year and a half ago. I mean, like no one was doing anything. And the price it took to clear big chunks of real estate was ridiculously unattractive just because no one was there to clear the market. But we've been working on and have knowledge of a couple of decent sized deals now that are getting taken out in that 6.75 to 7.25 range, which is quite a big favorable dip, like you're saying, Raymond, from 2024 and 2023. So that's a good thing. I mean, that's just a good thing, but the transaction volume is low. The 1031 market continues to be kind of dry. I mean, cap rates have inched up by 3 or 4 basis points a month for the last, 30 months, as we've kind of just slowly seen the cap rates rise. It's the market is not quite there like it used to be, because in order to have the 1031 market go, you got to have people wanting to defer taxes from other real estate that they've sold, a lot of which is in California. And then, it's not happening. People aren't selling real estate, so they're not trying to flip real estate and they're not trying to defer taxes. And so the market, which is really tax favorable market, that's what causes the 1031 market to really have juice. It's like putting kerosene on a fire, right? It's just not there. So there's not a kind of that piece of it. Cap rates averaging probably 7% across all industries. And these are asking caps, and they're probably about 6% in QSR business. So QSR is more favorable. Of course, between the lines here, you're going to talk about different brands and different lease terms. You're going to talk about different areas of the country. You could see a full 100 basis point swing in cap rates between areas of the country. The Midwest, interestingly, has struggled a little bit more than the rest of the country in terms of cap rates, probably on average a 0.5 point higher in the Midwest in cap rates than it would be in the Southeast, for example, or the Southwest. So those are things to talk about. And then the days on the market and the inventory seems to be steady. It just seems to be kind of a quiet, kind of slow situation. And there are a lot of real estate people that I know that have left their jobs and have, and that kind of thing in the last few months, just because it's been a tough place to make a living over the last 3 years. I mean, it's just the reality of it. So, but I think the message here, guys, is a good one, is it not? That the cap rates are coming down in the REIT market, that we have okay cap rates in the 1031 market. We just need them to clear a little bit. And there's this like natural thawing out that's happening. And it's probably setting the stage for probably 12 months from now for maybe things to really kind of crank up in the real estate side again. Who knows? That's not our primary area of focus, but just some commentary for you. How about EBITDA multiples? I'll let you guys answer that. What do you think about EBITDA multiples right now?
It's tough to give you an exact response just given the low deal flow. Our opinion is that they bottomed up and they're probably a quarter turn higher right now. If you were to compare them to a year ago, maybe half a turn for some deals. I still think the struggling deals, I think those multiples are going to stay low. I think, and talking with some lenders, they're going to be pretty difficult, if not borderline impossible to finance at anything but, extremely low leverage levels. I think lenders have been pretty nice to customers that have maybe defaulted on covenants and things like that, as long as they're still making the payments over the last few years. I think lenders are going to stop being so nice in certain situations and look to get out of some of their bad debt, and they're certainly not going to get new bad debt. And I think they're just going to keep harping on strong growing brands, because there's a lot of them, and that's where you're going to get the, Rick mentioned earlier, the smaller up and coming brands that are doing really, really well. They're generally too small for these national lenders to want to lend. The sentiment I hear, it's slowly changing. Obviously, the brands are growing, which affects things. But yeah, generally speaking, I think multiples are a little higher now than they were a year ago. But I guess time will tell.
Yeah. Gentlemen, any other comments there?
Yeah, I'd say, I mean, with, interest rates are still high, obviously, but I guess some positive news is there is some predictability for pricing on the deals.
Mm-hmm.
I mean, then also EBITDA multiples, of course, are going to change with, the brand, the size of deal, geography, current operations and trends of that particular business. All those are still going to play a major role for the multiple of your business.
Mm-hmm. I think we've done business in 2 brands in the last few months that attracted double-digit multiples in EBITDA, right? And then we've done business in a bunch of other brands that are like at the 4 to 5 times range, at best, right? So there's this bifurcation that's happening very clearly. To maybe put a little bit of mathematics behind our comments, on the high side with these double-digit or close to double-digit multiples, they haven't really changed at all. As a matter of fact, they may have gone up. If they're more of a brand that's maybe been around a long time, the multiples have stayed in that range for a long time without much change, just because the supply and demand is really good, even if the interest rates are higher. Over here, that these legacy brands that haven't been growing much and have been closing stores and have had kind of some bad way with them. I mean, they took a big dip in 2023 and 2024. And particularly in 2024, towards the middle of the year, some of the multiples had gone down as much as, what would you say, guys, 1.5 turns maybe from, and we're probably moderate. If you could stabilize the EBITDA in these businesses, they were probably around what the multiples were in the good old days of 2000, in the early 2000s, right? Yeah. Just like the historical good old days. And which, oh, by the way, that's probably more likely where they're going to stay for some of these legacy brands, because there's probably not going to be as many buyers come back to them ever that were here 3 or 4 or 5 years ago. Okay. So those brands are kind of drifted 150 basis points down, like to where their historical average was back 20 years ago. And I think Derek was saying they're up 1/4 to 1/2 turn of EBITDA, so that's kind of where they've maybe settled up a little bit from where they were, which may have been an overcorrection last year and a year and a half ago, potentially, and it just depends. And of course, we're speaking about this. I mean, we've got a bevy of transactions that we've done, of course, but we're not a perfect source here, and all this stuff changes by the minute. Any other comments on EBITDA multiples?
No, we've got a few questions that I can just go ahead, Raymond.
No, I was going to say the same thing. The only thing I'd add just on EBITDA multiples is kind of the importance of geography as well. I think we have a question in here just about the outlook on California. A lot of what we hear from buyers, if you're not already in California, there's not a whole lot of people looking to buy in that area, which naturally fewer buyers is going to hurt the EBITDA multiple. So just cognizant of that, outside of brand, I'd say geography is probably maybe the second most important factor.
Would it be true that it's very difficult to find someone outside of California to buy in California? Have we seen that ever happen, really?
Yeah, well, that's what I was about to touch on, and I'll run through a few of these questions that we've just received. I tell everyone I talk to, and some people understand it, and some people don't like my response. But one thing I am is honest. In California, it's tough to find a buyer outside of California. Your buyer pool is going to be someone within California that understands the regulatory issues and just is more comfortable with operating in the state. If you're outside of California, go talk to 100 people and you'd be lucky to find 1 or 2 looking to buy within that state. There are buyers because California is a huge state. What are there, 50 million people? You got 1/7 of the population in California. So there are buyers for California just simply due to the huge population, and not just the population, but in terms of business people. They're very centered in California. So there are buyers for California. I would say multiples are generally lower there just simply because the buyer pool is generally smaller. The law of averages, maybe you hit a home run, but maybe you don't. In terms of another question, can you talk about which brands are the double-digit brands and which ones are the lower ones? And once again, I'll be honest, we on these webinars, we're not going to talk poorly about any brand. If someone calls me, I can give my honest opinion, but on this webinar, we're not going to talk about the lower performing brands. The higher ones are going to be Wingstop and Taco Bell. You're looking at potentially double-digit multiples still in those brands. Am I missing any? I mean, those are the two. If we're getting calls for someone looking for something, 80% of the time it's Wingstop, and the other 15 it's Taco Bell, and then 5% for other brands. It's massively skewed toward Wingstop, really specifically right now, and then Taco Bell, and then a mix of others.
Mm-hmm. Yeah, I would add something to the California kind of discussion. I don't know this. I'm just talking as a business owner here. Like if I was in California and I had to pay such high taxes, it might actually make me more willing to acquire, right? Because I'm paying so much on the bottom line that I just wanted to keep feeding the beast. So you may have that buyers within the state, if the regulatory environment does thaw a little bit and clears up, you may find that those 50 million buyers or 50 million, people who live there, then that's been what's kind of kept that market fairly strong over the years, is that very phenomenon, I think. The opportunity in California, and also the fact that you're paying such high taxes, might as well put it into something. So let's buy something else. You know what I mean? So that's just a comment. Do we have any other questions in here? It looks like we had like 5 or 6 of them, huh? 9 of them, 10 of them.
When we talk about multiples of EBITDA, we're talking about it with G&A. Anybody that's seen our deals sees that we generally market these on an assumption for G&A. Every single buyer is going to have a different G&A structure. Generally about 3% of sales. Lower volume stores might be closer to 4.5% of sales. Just depends on the sales volumes, really. But that's generally about average. Our multiple is post G&A applied, not four-wall EBITDA. Do you count full franchise fees into your EBITDA, even though it's not residual? If you're referring to royalties, yes, we count that into EBITDA. If you're talking about like a franchise fee for a new build, I mean, we don't sell future stores really anyway, so that never really gets factored in. We don't really see buyers pay for future development. Maybe they pop their multiple up a little bit on the existing EBITDA for the opportunity, but nobody's paying you on future builds.
It's interesting, guys.
Go ahead.
Oh, yeah. I was just going to say, it's interesting. I was talking to a large franchisee yesterday, and it's Friday, and they said to me, they go, the Rick Ormsby formula for valuing restaurants. And I said, oh boy. And they said that, and so it reminded me that, like, I don't take any credit for this, but we're kind of like, we're the early adopters of how to think about valuing restaurants back in the early 2000s. And we did basically, you take store level EBITDA, add all the add backs, and some of the pro formas, as long as they don't become too egregious, we're not going to stand for that. And then you add back all, above store costs to the P&L and subtract a common G&A of, like Derek's saying, maybe it's $50,000 to $60,000 a store, or 3% or 3 to 4%, whatever, that there's some magic to that, to look through that. And then you come with a post G&A EBITDA, and then we apply a multiple to it. And that multiple is what we're typically referring to. The tricky thing is, when we refer to that multiple, we refer them to the multiple without the impact of future franchisor mandated remodeling expenses. Because if we don't, then we're not comparing apples to apples when we're talking deal to deal and brand to brand, right? Because every brand has a different remodeling schedule, and every franchisee has a different number of stores. So when we're talking multiples, we're talking gross, gross multiples. So we have a gross multiple, and then we have a net multiple. We always quote the gross multiple. And if you're asking this question, it means that you probably have never seen one of our deals. I'm not sure of that, but it probably means you've never seen one of our deals. But we do then always ask folks to consider, and lay out schedules of remodeling expenses by year for each restaurant, or each franchise, whatever it might be. Sorry about that, if that was too much.
You take the multiple on the post G&A EBITDA, that's going to be the gross price. But if there's a $500,000 remodel that's past due, we're going to expect buyers to reduce their price. Effectively, the net multiple that you will see is lower than the gross multiple. We always factor in future CapEx.
Yeah.
Mm-hmm. Absolutely. Yep. Yeah. What more questions? Let's take 2 more questions, then we'll keep bouncing. How about that? Or maybe there's no more questions. I see a bunch of them, but I'm afraid to touch it. And then all of a sudden something frees up.
Yeah. Someone's asking about regional brands and the multiples. We don't do a massive amount of the smaller brands. So I don't have a perfect say there. You're asking if 2.5 to 3 is normal. That feels a little low. Ultimately, it depends on the buyers.
Mm-hmm.
I mean, if you can't make we saw this recently, there's a deal where it was a national brand, and you would think, I'm not going to mention the brand or where it was or anything, but you would think that should be a 5+ times deal all day. We struggled to find someone for sub 4. And that's just how it was. It depends on how many people want to buy that asset. If it's a small regional brand and you've got 5 potential bidders, you might get 5 to 6 times EBITDA. If you got a small regional brand and there's only one potential bidder, well, guess what? The market is that buyer, and whatever that buyer is willing to pay, if you're willing to sell, is what it's going to go for. Pretty simple. So people talk about the market all the time. The market's only as good as the buyer.
As your buyers are. Yeah.
So,
well, in a small regional brand, there's a lot of questions like, is this small regional brand growing, or is it basically had the same unit count for the last 10 years? That, to me, if it's a small regional brand that hasn't grown much, I'm immediately thinking low multiple, everything else, considered, because it's going to be hard to finance. There's probably not going to be a lot of buyers, because they don't have an active franchise sales group, and they're not building new units and not bringing new blood into the system. And so there's not a lot of excitement probably for the brand. If it's a small regional brand that's growing a lot, it could be a different story. You could see the difference in multiple there being two turns, maybe potentially. But one thing I will tell you, and I think you guys would agree with me, that even though these emerging brands have a lot of excitement to them, some of them I'm seeing crazy EBITDA numbers. These guys are printing $400,000 or $500,000 in store level EBITDA out of these new brands and new stores, and it's just crazy. And my jaw drops and hits the ground every time I see it. But even some of those concepts, when they have a low unit count, their valuation in the market is quite a bit lower than what you might think that it would be, because it maybe hasn't caught the ear and the eye yet of the lending market, and there's not a big enough store base to attract enough buyers who are going to come in and throw that massive multiple on the ground. So is it 1,000 units and 10% unit growth a year? I mean, if you're like a small emerging brand that's really growing, I don't know. I just throw that out there. I don't know that that's right, but it's kind of something to think about, and if you're a 200 or 400 unit brand, it's going to be hard to garner a big multiple because it's going to be too small and too speculative, especially for the financial buyers who are going to have a charter that says that we can't own a certain percentage or more of a brand's stores, or we need to only invest once it has XYZ in terms of a number of units, right? So those are some things to think about. Anything else?
Rick,
One more.
I think the next question on our list was the lending market.
Yeah, let's go for it. Yeah, lending market. What do you guys think? What's happening in the lending market? That's a germane question, and we got some good stuff to say. So fire away, guys.
At a high level, there's not a lot of deals happening. They're not financing a lot of deals. We're hearing the same thing from lenders we talk to. The business is just not very robust right now. So I think you've got a lot of lenders that want to throw money at transactions, not bad ones. I don't think you're going to see lenders taking on lower performing brands right now. If you've got a business that's averaging $40K a store of EBITDA, I don't think you're going to find a lender that'll take it on unless you have a personal relationship with them and they have another reason to do so at a low leverage. Taco Bell deal is not going to have an issue. Wingstop deal is not going to have an issue. Some of the tier 2 kind of medium brands that are performing well, you'll be all right. But generally speaking, lenders are out there and they're hungry and they want to give money, but they are going to be careful not to throw money at everything. That was happening maybe back in 2021 a little bit more, where just every deal was getting financed no matter what. You're not going to see that nowadays. If you thought you could get 5.5 lease adjusted leverage before, maybe drop that to 5 and 5.25. Obviously, it depends on the lender. Some are going to be more aggressive than others, and it depends on the brand. Some top brands, you're still going to be able to get 6. Anybody else?
I think.
Mm-hmm. Yeah, I think you're exactly right. More optimism definitely out there, but still very careful in what they're lending to. A lot of competition for the higher performing brands. At least adjusted leverage, you're right, coming down some, but also fixed charge coverage ratio become a bigger thing more recently with higher interest rates. The interest payments picking up so much more of the payment now compared to years past. It's just made that much more important.
Mm-hmm. debt to EBITDA being a third factor when you're thinking about if you don't know the formulas, reach out to us and we'll tell you. But it's lease adjusted leverage, fixed charge coverage ratio, and then debt to EBITDA. And these are like the three metrics that these banks are always consistently looking at in terms of what they're going to advance and how they're going to advance it to you. Rates. SOFR is our new metric. So that's running around 4.5%, 4.6% right now. And then plus a certain amount of basis points is typically how lenders think about it now. So if they're at SOFR plus 250 or SOFR plus 200 or SOFR plus 300, then think of that as like 4.5%, 4.6% plus 2% or plus 2.5% or plus 3%. So you're looking at, typically 6.5 to 7.5% loans right now, and floating kind of loans, and the spreads are tightening, we hear. And the reason why they're tightening, and the comment is a good comment that they're tightening. It means just what these gentlemen have said, that there's competition. And because no one's refinancing and there's very little M&A, people are willing to squeeze a little bit. But it's one of these bifurcated things again, like they're either going to squeeze and the spreads are going to get narrower, and maybe you can get to the low end of that SOFR plus 200 to 300, or you're not going to get it at all. If it's a brand that has $40,000 per store in average EBITDA, no one's going to touch it in this market. Any other comments you guys have?
I would just add, correct me if I'm wrong, but all of our M&A transactions, are able to find lenders. Just going off kind of what Derek said, lenders are obviously very careful with, who they lend to. At Unbridled, we also do a lot of vetting prior to taking an assignment. If you look at us compared to our competitors, our closing rate is significantly better. And that's because we take on businesses that, we know that we can close.
Yeah. I appreciate that, Raymond. Look at that, man. You're putting a little one up on Unbridled. It's true. And these guys, not me, are the reason why it happens, right? I mean, they look hard. I mean, oftentimes harder than any lender would, to make sure that the business that we're representing is financeable, is closable, is sellable. And so that's the reason why we keep this crazy high success rate. Thank you for saying that. It's cool. Thank you.
For context, and just for context for everybody on the call, and we say this pretty openly, I think in 2024, and when I say turned down an assignment, it's not always turning down, but either turned down an assignment or our valuation spread versus the expectation was just too wide, in which case we wouldn't move forward with an engagement. I think we turned down or didn't come to an agreement with almost 50 valuations we did last year. So that's essentially almost 50 deals that you could have seen from us, in which case maybe we could have closed 10 of those, 20%, but you didn't see them. And they either held and trusted our opinion that the expectation was out of line, and just not out of line, but out of market, or they hired somebody else. So typically you're going to see deals from us that we've vetted pretty hard, that we feel confident the seller's expectation is market. Now we're going to go get the best market price, but it still has to be within the realm of market. We're not magicians. We're not going to go out and get 7 times for a deal that should be 5x. That doesn't happen. And we won't take deals where that's the expectation.
Although I'll say that maybe I heard something that makes me feel like Derek might be a magician. Guys, he told us that he finished third in a 50-mile, trail run where he was blind. He was temporarily blinded for the last, 15 miles and still ran? First of all, dude, that is outlandish. You need to, you're going to kill yourself. And second of all, how do you run blind in a trail in Moab? How do you do that?
Very, very carefully. And fortunately, there was a shorter race going on. So the last 10 miles, I was kind of joining with the mid to back of the pack runners in that race. And I would use their shadows as kind of guideposts to make sure I was on the trail. But yeah, I could turn my ankle a couple times. I could barely see my footsteps. It wasn't black. Everything was just really blurry. And by the next morning, I could see again. It's apparently not a completely unheard of phenomenon. So I'm trying to figure out how to prevent it next time.
Derek,
you called up with the shorter race. That's pretty impressive.
Yeah.
You had to.
You all know that I was that I like to teach the Bible, right? So there's a very good sermon here, and I was once blind, but now I see. Derek, you know what I mean? I once was blind, but now I see. Amazing Grace. You guys know the song Amazing Grace, right? Beautiful song. Anyway, sorry about that. There goes the rabbit over here, right? So back to we've got just, another 10 minutes we're going to talk. Let's go quickly through these other things. Yesterday's buyers were family office and PE consolidators. Who is today's buyer?
I think we can say without a doubt, most of our buyers have been the strategic ones. We just aren't seeing the new PE and family offices enter the space as much as we used to. Don't get me wrong, we still work with the ones that are already in place, but just don't see the new entries seriously considering some of our deals. The mid-sized strategic buyers seem to be more in play than in the past, as their price isn't far off. A lot of situations, they're just the same. I mean, they've come up a lot. I think a lot of that has to do with them losing out on deals in the past before multiples were so high, because multiples were so high. But now they're kind of closer to the norm and are willing to be a little bit more aggressive than previously, and still being close to, what they would have offered a few years ago from a multiple standpoint.
Yeah, I think that's a good answer. Thank you. Let's let that one sit. Good work, Peter. Let's jump into a couple other questions. This is one I think that's a good one. Why would someone want to sell a franchise business now, knowing that, of course, we did make a comment, or didn't we make a comment back in the lender section about how the fitness business is challenged a little bit right now in the lending market. So let's just talk about restaurants right now for a minute. Why would someone sell something now? Give me a reason. Pitch me on that.
I mean, like the majority of this call, we've said everybody's pretty optimistic. So generally speaking, you're not going to see a lot of people selling. And I tell people all the time, very rarely do you see a franchisee sell for pure financial reasons. I mean, it's one thing if you're in Wingstop and you can go get 11 times EBITDA, or a Taco Bell deal where you can get 10 plus times EBITDA. But if you're selling for, 5x, a pretty normal average multiple, it's usually not a pure financial reason. You're either at retirement age. A lot of people after COVID were just fatigued and tired and just wanted to be done. Maybe you don't have a succession plan. You've got some other aspect in your life. Maybe you have another venture you want to go do. Usually, or politically, maybe you're scared of the future. That happened a lot back in 2021 when people thought taxes were going to go up. Ended up not happening, but that pushed a lot of people out in 2021. Usually there is a primary reason people sell. The financial aspect of it is usually somewhat secondary. People call us and say, I want to sell. And we say, okay, it's 5.5 times multiple. And they say, okay, that's great. If we told them 3.5, maybe they would hold it. But if it's a normal market expected multiple, that's almost secondary. Right now, there's not a lot of reasons. People aren't scared politically that taxes are going to go sky high. People feel pretty good. If you weren't a seller in the last couple of years, when you thought maybe another Biden or Harris administration was going to happen, why would you sell today in terms of that regard? You probably wouldn't. That said, there are no other deals. You will get a lot of eyeballs on your deal if you go to market today. Inherently, hopefully, that pushes your price up a little bit. Maybe it makes it a little bit more attractive. Maybe you have your pick of a buyer. That doesn't get talked about a lot. There are very easy to work with buyers and there are difficult buyers. If you can attract 10 offers to your business, you're going to have your pick on who you get to work with. Maybe you have a buyer that has a really good reputation. They're really quick, easy to work with. Diligence is 30 quick days and not a 120-day arduous process. So, you're going to have a little bit better maybe pick of the litter in terms of buyers. Rick?
I got some things to say. Raymond, you got anything to say? You've been quiet for a bit. Let you talk. Say something if it's in your head.
Yeah, no, only thing I'll add is, even if we're all on this call, I think pretty optimistic about the future, the important question I think to ask yourself is, what stage of life are you in? If you're approaching retirement, or you are just getting tired, or even if you think it's a few years away. I mean, many of our clients that we bring to market, we've done multiple valuations with them over multiple years. It's usually not, our first point of contact is they're ready to sell. So I'd just say, even if you're thinking about it and just want to understand how the market works and how our process works, I just say, don't be afraid to reach out.
I think it's great. It's great. A couple of things I would say. So to answer your question, Derek, why would you sell now? Favorable supply and demand situation, right? Very favorable. That would be one reason. Number two, if you're operating a really high quality brand your multiple really hadn't changed a whole lot. So your multiple's still high anyway. So, and on top of the high multiple that hadn't changed a whole lot, there's no one else selling anything. So you're actually probably going to get a better outcome than you expect, but that's in a limited situation. And then a third thing that I would say, we'll talk about this. This will be something. So pay attention for this next question is franchisor situations can be volatile and they're increasingly heavy-handed. They're increasingly involved in development. They're increasingly also interfering with transfers. And these things, if looked at into the future, could pose a risk into the value that you could get in the future for selling something that you otherwise sell now. And I think that's a real palpable risk in some brands. I don't want to talk particularly, but they're getting more heavy-handed. They're asking for more. They're getting more difficult to get a deal approved. And that is something that you need to be thinking about. And I think if you're operating a legacy brand, why would you sell now? Maybe because your legacy brand is in a declining market share environment that's not going to turn around. And you got to be realistic about that, man. If you're operating a brand, that could be the next Howard Johnson's in 5 to 7 years. Like, don't be out there selling it in 6 years when there's only 500 stores left. You know what I mean? You don't be the last guy holding the bag. Sell it while it still has value, while there's still a market for it. And then the other thing is the turnaround we may be wrong. This turnaround that we're talking about and this optimism that I think everyone on this call is sharing, amongst our company it may be wrong. It may take 2 or 3 years or 4 years to be effectuated. We've done some daggone damage to this country over the last few years, right? And so if it takes that long, how old are you and what's your time worth if you're 65 years old and you want to be with your family and you have bigger plans for your life other than operating a business, So these are very personal things to think about. Let's talk one more, maybe let this be the last question. Okay. And, there's other things this will be question 7 of 10. So there's others. You can call us. We can talk about anything you want to talk about, but let's talk about franchisors a little bit more. So what's your comment and what would be your advice to any operator, to any would-be buyer, or to any would-be seller of the franchisor situation?
All right. So again, we're not going to pick out any franchisor, but what we're generally seeing is what Rick just said. They're just getting a little bit more difficult in approving, and maybe that's because of some of the struggles that some franchisees have had. So it's hard for me to look at it and say it's necessarily wrong. It's probably not horrible for the specific brand, but it will reduce the buyer pool and it will reduce prices in the end. That's going to be the outcome, whether or not what is happening is right or wrong. That is the likely outcome. You're seeing some brands pretty adamant against financial buyers and PE groups. Those are struggling in certain brands to get into. The contiguous geography thing is really big. Like I said, if you're a franchisor, it probably makes sense. You want your franchisee to be in the market running the stores. I'd say history shows that those markets are probably operated better than having a distant franchisee. But it's going to limit the buyer pool and it will absolutely limit the price. And that is a growing trend that we're seeing increasing amongst the franchisors. And I'd say that might be the biggest one, is that's going to limit the New York group, the financial group, the brand saying, are you going to move out of New York to, I don't know, Mobile, Alabama? And the answer is obviously going to be no. And they're going to say, okay, you can't do the deal. Some brands are limiting the size you can get to. I think RBI was pretty loud about this, that they have a loose 50 unit cap now. Well, financial groups don't want to be limited to 50 groups or 50 stores. They want 200. So it totally knocks those buyers out. And generally, those buyers were the ones pushing up prices at one point. They're getting a little bit more cautious on leverage. I'm hearing a big brand out there forcing 30% equity, which isn't that crazy, but it's a change. And they're going to lower the leverage that you're going to be able to get, which, depending on the buyer, is going to lower the price they're willing to pay. Remodel requirements are rolling out. It's one thing if you've got a brand showing that there's a $400,000 remodel, but you get a 15% sales lift that continues and isn't just a temporary boost, and they can show that the ROI is 30% on this remodel or it's a 3-year payback. Most legacy brands cannot show that. And most of these remodels, the ROI or the payback is paltry at best, but they think it's important and they're forcing it. And that's a big expense that's going to affect your You might have all the EBITDA in the world, but if you've got to spend half of it remodeling your assets, you've got to look at the underwriting on that. And that's why we take CapEx into effect on our pricing. So we always look at that when you see a deal from us. And there's
It's
just
almost like
a trend. You mix all these things together, and you've got a trend of franchisors turning down buyers. So if you're a buyer willing to pay you 6 times and the corporate says no, well, you're going to be stuck with the buyer willing to pay you 4.5. That's the ultimate outcome. Whether or not,
what do you got, Peter?
That's the outcome.
Yeah, what do you got, Peter? Good. I appreciate that, Derek. It's very good. Yeah.
I was just going to mention, I mean, it's almost like the franchisors trying to reverse some decisions they've made in the past by getting more difficult and improving some of these buyers. You know, you mentioned it, Derek, contiguous markets, financial requirements, development agreements. They put, I think the reason is they're putting so much more emphasis on this is because it's caught up with them from the past. Now they're trying to do the opposite. And unfortunately for sellers, it's no really fault of their own. You know, also, I mean, it's also important because of these things is to have multiple backup options, multiple quality offers from other buyers. And so it's really important to have a good advisor to collect those offers at the beginning of the process. And so if option 1 does not work, you can move on to option 2 that was about the same, and you still have the same kind of result.
Yeah. I mean, I would just say, just to give you some data to think about this, like in prior years, in many of the prior years, we would go the entire year without having a single buyer on a business get turned down by corporate, and now it's a pronounced trend. A lot of the deals, but the corporate turns down the buyer. So, I mean, and that's happened just in the last 18 months, and it's pretty pronounced. It's a sharp difference. It's like going to the beach or 100 feet of snow, kind of difference. So something to watch for in the future for sure. And I guess this is going to end this episode here. And I want to thank you guys, everybody who attended. I wish you a wonderful 2025. Gentlemen, thank you for your time. As always, if any of you who have watched or listened want to reach out to us, please feel free. We'll continue with the content. We'll continue hopefully with the deals. And we're here for you, and expect something in your email if you want to see a follow-up, or if you go to unbridledcapital.com, you can find all of our content. So thank you so much, and we're signing off, and take care. Thanks so much for entering the Boiler Room today. You can find our podcasts on iTunes, Google Play, Stitcher, TuneIn, and Spotify. If you like these podcasts, please listen, rate, and review. I also encourage you to visit our website at www.unbridledcapital.com for the best franchise M&A and financial resources in the industry. Our website includes webinars, podcasts, videos, white papers, and a list of our past M&A transactions. Please note that neither Rick Ormsby nor Unbridled Capital Advisors LLC give legal, financial, or tax advice. These podcasts represent opinions that have been prepared for informational purposes only. We expressly disclaim any and all liabilities that may be based on such information, errors therein, or omissions therefrom.